I like the smile on your face. What is the secret? Some client has committed a large quantum of money to your PMS?
Or not really. We have seen tapering off of flows, though flows have still been positive, but they have come off from January, February levels. So I think the optimism comes from the fact that the quarterly numbers for Q1 have been pretty satisfactory, and more than that, the mid and the small cap space, adjusting a few names in the financial space, in the PSU banks, etc. They have broadly met numbers expectations. So if you talk about 20% sort of a pad growth that we've seen in the mid and the small cap universe, so that gives some degree of comfort as far as the prices, the fact that they have corrected so much that there's not too much of room on the downside. And you'll have something to worry about in the markets at all given points in time. So whether it be oil prices or trade wars, etc., and they will keep you on your toes. But the point remains that if earnings start to pick up and valuations have corrected, that gives that much margin of safety. So that is the main reason for the optimism, and still remain positive. I think markets still have a long way to go from these levels. I mean, not be surprised if you can see 20-25% returns on the broad headline Nifty from the next 1 year perspective.
So Manish, where are we headed now? We started the year with a dream, it was more like a dream start. There was euphoria, froth in the small and mid cap stocks. Then came IT, which made a comeback because of earnings and because of weakness in the dollar. Suddenly corporate banks are the flavor of the moment. Pharma stocks are no longer beaten down and bruised out. What exactly is the market telling you? Is it time to rotate, or currently the rotation rally is just a dead cat bounce and it will be back to consumers, retail NBFCs and private banks?
No, so markets are trying to tell you two things. One is that there is enough money that is waiting to get put in the markets. Give me a correction in valuation, and if the story looks good from like 2 to 3 years perspective, I am willing to take that call. So or you give me stories where the growth is still there, and the visibility of growth is maybe on a longer period, slightly on the higher side. I'm willing to pay you higher valuation. So I think this is what the markets are exactly telling you. Nobody is interested basically to buy in cheap stocks or the undervalued so-called contrarian stocks where there's risk on the capital. So that is exactly what the market. Give me growth stocks, give it to me at a reasonable price, and be willing to buy them. There's enough money on the sidelines waiting to buy into these stocks.
So where is it that you're or rather finding, Manish, a match of both, that is price as well as value on the table?
So, one of the stories which has not exactly played out as we had expected was the GST transition. You are seeing a lot of them in certain pockets in the consumer space, something like a footwear, something like the retailing space, something like the luggage space here and there. So it's not yet exactly played out. So I think the test of that is going to happen and markets are not yet willing to believe all those theories about GST transition, unorganized, organized. Of course, it's not yet shown up in the numbers, and the proof of that will lie in the numbers that get reported by many of these sectors and companies within those sectors from the third quarter and the fourth quarter. So, this is one space which can give you extreme positive surprise going forward, and there is far more upside in the stock prices of many of these stocks in these sectors which are yet to be realized. So I think the names continue to be the same. It's the same consumption within the private sector, BFSI space. I mean, corporate lenders will do much better than, let's say, the retail focused lenders, because the price differential vis-a-vis the valuation is extremely high in the case of corporate lenders as opposed to private sector. They will also grow, but I think it's more than price to perfection for the near term. They may see some time correction, whereas the corporate lenders, because they have not seen any price action as far as valuation and fundamentals upgrade is concerned, they will tend to do better. So It's the same BFSI, it's the same consumption names. Many of the import denominated sectors are likely to feel the heat. Consumers of commodities are going to be much better placed, if we have a full-blown trade war, because that's going to impact material prices significantly. And whether it be usage of copper, whether it be usage of zinc, lead, all these spaces are going to see improvement in prices.
Is that the reason why you would say that a Page, Bajaj Finance and a Kotak are looking expensive now and to book profits there? Is that what you're recommending?
No, that's not the strategy. Basically, they have run up so much, they can go through time correction, but there is a lot of growth that is left in many of these names even now. And it is easier said than done that you flip these stocks because they are more than fully priced for the near term, and then to buy back again, when the growth comes back again in this. It's not done very easily, particularly if you are managing funds on a large scale and you want to take 5-10% allocation into these names. The price impact is just a bit too much. So, if the growth trajectory is still there for the long term, there will be periods when the returns come much front-ended as opposed to the fundamentals which they present on the table. Strategy is to live through the time correction, because I don't think they are going to see too much of price correction and then wait for the next leg of journey to see appreciation in stock prices. I think that remains the strategy.
Manish, some of the names that you've bet big on, and I guess Bata is the rationale that you've already given us because of the GST transition still to go through in footwear, for instance. But some of the other names like in Aegis Logistics, for instance, do you still have that conviction call?
Yeah, I think the numbers are pretty okay, but we got to, because of the Ujjwala scheme and a lot of things are actually happening in that space, and the biggest and there's a long way to go, and I believe that the business model of Aegis Logistics is a pretty capital light asset model that you have. The biggest risk on the company comes from the commissioning of the BPCL's own terminal out there, IOC's own terminal out there, because the Haldia, which the terminal is fully operational, and it's a long way to go. You have a 5 million ton capacity out there. So other than that, I don't see too much of a risk, because it's a conversion model, it's an asset light model, it's a services business. I mean, one can argue about the valuations, it's slightly elevated, but again, if you have a niche business model, where you don't see too much of competition coming in the near term, and competition coming in either from the PSU, OMCs or the private sector, I mean, that remains the biggest threat to the valuations. Other than that, it's a pretty decent business model.